What if the greatest fortunes in modern history were not built through innovation or brilliance, but through carefully orchestrated manipulation of global markets hidden in plain sight? Imagine discovering that behind every major boom, every sudden crash, and every mysterious shift in global finance, there was always the same pattern of silent hands pulling the strings. This opening truth is uncomfortable because it forces us to question what we think we know about wealth, merit, and economic power. But when you trace the origins of these massive fortunes, when you peel back the polite language of market forces and economic cycles, you uncover something far more deliberate, a system shaped by financial barons who mastered the art of controlling narratives, exploiting volatility, and engineering crises for profit. This is where the story begins, with the hidden machinery of influence. Long before algorithms, derivatives, and globalized trading, early financial elites understood a simple principle that still drives the world today. Uncertainty is profitable. When the public panics, insiders accumulate. When markets rise irrationally, insiders unload at the top. The illusion of chaos is often the product of precise design. These barons learned how to trigger fear, amplify speculation, distort supply and demand, and then quietly position themselves to win no matter which direction the market moved. Their success was not accidental, it was engineered. And the most striking part is how these tactics evolved into a blueprint that repeats across centuries. From early banking dynasties influencing sovereign debt to modern hedge funds manipulating currency flows, the pattern stays the same. Control information, influence perception, and exploit timing. Once you understand how this machinery operates, you begin to see why financial crises seem to emerge at the exact moments when certain players benefit the most. You start to realize that the gap between public narratives and private incentives is far larger than anyone admits. You might even recognize echoes of these mechanisms in events you have lived through without ever noticing who profited behind the scenes. You ever felt like certain financial events just happened too conveniently, almost as if someone anticipated the chaos before it unfolded? You are not alone. What you're about to explore may challenge your assumptions, and what comes next will reveal how these hidden strategies shaped everything from global currencies to national economies. Before we move forward, tell me your experience. Have you ever watched a market crash or sudden boom and felt something didn't add up? Share your thoughts, hit the like button, and make sure you are subscribed so you do not miss what comes after this, because the next steps in this story connect directly to what you have just uncovered, and the deeper we go, the more shocking the pattern becomes. As you trace the origins of financial manipulation back to their earliest forms, the truth becomes even more unsettling. The foundation of modern markets was built on mechanisms that were never designed to be fair, equal, or transparent. In the beginning, when global trade was still taking shape, those who understood how credit, currency, and political influence worked quietly positioned themselves above the very systems they were helping to create. They were not simply participants in an emerging financial world, they were its architects. And architecture always reflects the intentions of its builders. These early financial barons learned quickly that if you control the flow of information and the structure of debt, you control the behavior of entire nations. Credit became the first tool of manipulation. Governments needed money for wars, expansion, and industrialization, and lenders discovered that providing that money came with immense leverage. When kings, parliaments, and empires depended on borrowed capital, the lenders were the ones actually setting the terms of power. Interest rates, repayment schedules, and refinancing agreements were not just financial decisions. They were acts of influence shaping alliances, treaties, and even the outcomes of conflicts. Markets did not move based solely on supply and demand. They moved according to the pressure points created by those who held the debt that nations could not escape. The second tool was the control of perception. Early financiers learned how to sue, manipulate expectations, long before psychology became part of economic theory. By spreading rumors about shortages, failures, or political instability, they could trigger panic selling. By hinting at prosperity, recovery, or new opportunities, they could inflate demand. And because news traveled slowly, the ones who moved first always profited the most. They had the luxury of acting on information before the public even knew something had happened. This asymmetry became a permanent structure of the market, a built-in advantage for insiders that has never disappeared. Then came the institutionalization of these practices. Financial markets created standardized debt instruments, stock exchanges, and futures contracts that appeared to democratize access, but in reality concentrated power even more tightly. Those who controlled the early exchanges controlled who could participate. Those who managed sovereign loans determined which nations would prosper and which would struggle. Those who set the rules of trading were the same people who benefited from the way those rules were designed. Manipulation was not a flaw. It was embedded from the start. And in this environment, great fortunes grew, not from innovation, but from understanding how to exploit fragility. By destabilizing competitors through targeted speculation, by influencing monetary policy from behind closed doors, and by pressuring governments through strategic lending, these early financial elites established patterns that still operate today. Once you see these mechanisms forming at the roots of the financial system, it becomes impossible to unsee how similar dynamics play out in every major crisis and every sudden shift in global markets, revealing a lineage of influence that connects past barons to modern power players in ways far more direct than most people realize, creating a continuum of control that still shapes the economic landscape we live in. As these early financial structures solidified, the rise of the first true barons of global finance became inevitable. They understood something that ordinary merchants, governments, and citizens had not yet realized. Money itself could be shaped, directed, and multiplied through influence rather than production. These figures were not simply wealthy traders or clever businessmen. They were engineers of a system that rewarded those who could manipulate its levers, often from behind layers of secrecy. Their power did not come from visible authority, but from silent control over liquidity, credit availability, and the flow of international capital. Once they recognized how fragile national economies were, they turned that fragility into an engine for unprecedented profit. These barons mastered the art of positioning themselves at the intersection of risk and opportunity. When markets froze, they provided liquidity at premium conditions. When governments panicked, they offered loans that created long-term dependency. And when rival financiers attempted to challenge their influence, they used coordinated speculation to weaken their opponents' positions. Currency manipulation became one of their most potent tools. By purchasing or dumping massive amounts of currency at decisive moments, they could destabilize entire regions, forcing governments to respond in ways that benefited their interests. The result was a growing awareness within political circles that financial power often outweighed military or diplomatic power. Because markets could collapse nations without firing a single shot, information asymmetry continued to expand their influence. The barons had networks of informants, diplomats, traders, and analysts long before intelligence services even existed in formal structures. They knew when a kingdom was running out of silver, when a shipping route was compromised, when a drought threatened food supply, or when political turmoil could shift alliances. Every piece of information was a potential advantage, and they treated these insights not as knowledge but as weapons. While the public struggled to understand sudden price swings or unexplained shortages, the barons were already moving capital into positions engineered to profit from those very outcomes. What truly elevated these financial dynasties was their ability to embed themselves within the economic machinery of nations. Banking houses evolved into institutions so essential that governments could not function without them. They structured national debt markets, influenced tax policies, guided currency reforms, and shaped the evolution of financial law. By advising rulers on economic policy while simultaneously profiting from the outcomes of that advice, they created a self-reinforcing cycle. The more indispensable they became, the more untouchable they were. Their fortunes no longer depended on ordinary business success, but on their strategic mastery of global interconnectedness. Once these financial dynasties established their legacy, the rules of the game shifted permanently. Market manipulation was no longer episodic, but systemic. Crises were no longer unpredictable shocks, but opportunities engineered by those who understood how to bend the system's architecture for their own gain. And as their techniques matured, the line between economic policy and financial strategy became increasingly blurred, setting the stage for even more complex forms of manipulation that would soon shape the global order in ways future generations would struggle to recognize. As these financial dynasties expanded their reach, something even more consequential began to happen. Manipulation stopped being a hidden tactic and slowly evolved into the structural foundation of global markets. What once depended on the ambition of individual barons turned into an organized framework embedded within institutions, regulations, and even the psychology of investors. It was no longer necessary for a single financier to move markets with a bold stroke. The system itself had absorbed the logic of exploitation, making manipulation almost indistinguishable from legitimate economic activity. What had started as discrete intervention transformed into an economic ecosystem fueled by engineered volatility, speculative leverage, and policy decisions shaped behind closed doors by those who understood how to convert turbulence into profit. At the core of this transformation was the growing complexity of financial instruments. Early markets were built on tangible assets, land, commodities, gold, and industrial output. But as financial engineering advanced, wealth shifted toward abstract instruments detached from physical value. Derivatives, futures, credit agreements, and cross-border debt structures became tools for amplifying gains and hiding risks. These instruments gave insiders extraordinary advantages because they could influence outcomes without directly touching the assets themselves. By spreading exposure across multiple markets, they could trigger chain reactions that destabilized entire sectors while remaining safely insulated from the effects. The distance between cause and effect grew larger, allowing manipulation to occur in silence while consequences appeared to unfold naturally. Regulatory bodies, often created to prevent abuses, became entangled in the very mechanisms they were meant to control. Policies intended to stabilize markets frequently ended up reinforcing the dominance of established financial powers. By setting standards that favored large institutions, regulators inadvertently marginalized smaller players, ensuring that only those with deep capital reserves and sophisticated infrastructure could participate at scale. This created a feedback loop in which the same institutions influencing regulations were also the ones best positioned to profit from them. Public narratives describe these developments as modernization or necessary reform, but beneath the surface, the strategy was clear: consolidate influence, limit competition, and normalize practices that quietly shifted risk away from elites and onto the broader economy. And perhaps the most revealing element of this shift was the emergence of coordinated market behavior, disguised as organic movement. Clusters of institutions acted in parallel, responding to signals that were invisible to the public but obvious to insiders. Liquidity surges, synchronized short selling, sudden currency devaluations, and targeted asset inflation looked spontaneous to outside observers, yet each served a strategic purpose. The more these patterns became normalized, the easier it was for financial giants to operate with near impunity. Manipulation no longer required deception, it required momentum. And once momentum took hold, even honest participants became part of the machinery, contributing unknowingly to a cycle designed to favor those who had shaped it from the beginning. If you have ever noticed how certain financial events seem too coordinated to be coincidence, or how markets swing in ways that defy logic yet benefit the same recurring players, share your perspective in the comments. Your insight adds depth to this conversation and may reveal patterns others have sensed but never fully understood. As the system normalized this coordinated behavior, a darker pattern emerged. Some of the most devastating financial crises in history were not random explosions of instability, but carefully exploited opportunities that enriched those positioned to benefit from collapse. When you examine major market crashes through this lens, a striking consistency appears. In the months, or even years preceding each crisis, key financial actors accumulated positions designed to explode in value once panic took hold. They understood that fear was one of the most powerful forces in economics, capable of wiping out decades of progress for ordinary citizens while generating monumental gains for those prepared to capitalize on the downturn. The cycle became predictable: inflate asset prices, encourage public participation, quietly exit at the peak, then buy back distressed assets for a fraction of their former value after the crash. Booms themselves were often engineered with equal precision. By injecting optimism into markets through liquidity expansions, selective lending, and strategic media narratives, financial elites encouraged speculation on a massive scale. Ordinary investors, unaware that the enthusiasm was manufactured, poured their savings into rising markets. Meanwhile, insiders monitored the expansion of leverage, waiting for the ideal moment to trigger the reversal. Once valuations reached unsustainable heights, the same institutions that had amplified the euphoria shifted into defensive positions, reducing exposure while subtly pressuring the market downward. The public faced a collapse that appeared sudden and inexplicable, while insiders experienced it as a calculated transition from one profit phase to the next. This pattern extended beyond stock markets into commodities, real estate, sovereign debt, and currency systems. Entire national economies were pulled into cycles of artificial appreciation followed by intentional destabilization. When a country's currency soared beyond reasonable fundamentals, exports weakened and debt burdens grew heavier. When the inevitable correction occurred, global investors swooped in to purchase national assets at discounted prices. These cycles eroded the independence of governments, forcing them to rely even more heavily on the same financial institutions that had contributed to their vulnerability. In this way, crises became mechanisms of control, redistributing wealth upward while tightening the influence of global finance over political decision-making. What made these engineered crises so effective was the narrative crafted around them. Public explanations emphasized natural economic forces, market psychology, or unforeseen events. Very rarely did mainstream narratives acknowledge the role of strategic positioning or intentional amplification of risk. By maintaining the illusion of randomness, financial barons protected themselves from scrutiny and allowed patterns to repeat across generations. People affected by crises blamed themselves for poor timing, excessive optimism, or lack of knowledge, never realizing that the system was structured to disadvantage. them from the start. Yet the deeper you analyze these events, the clearer it becomes that the real architecture of global finance thrives not on stability but on volatility. Moments of chaos serve as resets, clearing the field so that insiders can rebuild their advantage, accumulate new assets, and prepare the next cycle. And as these cycles became more sophisticated, so did the tools used to orchestrate them, setting the stage for an era where massive wealth transfers could occur without the public ever realizing the true origin of the turmoil they were living through. As the 20th century progressed, financial manipulation entered a new era, defined not by individual ambition alone, but by sophisticated systems capable of reshaping the entire global economy. The rise of advanced financial engineering introduced tools that could magnify both opportunity and destruction on a scale that earlier barons could never have imagined. Derivatives, synthetic securities, leveraged instruments, and algorithmic strategies expanded the potential for profit while simultaneously creating layers of opacity that made it nearly impossible for the average investor to understand what was happening beneath the surface. Risk became something that could be packaged, sold, insured, rehypothecated, and redistributed until no one could trace where the true danger resided. This complexity was not accidental. It served as a shield for institutions that mastered the structure well enough to manipulate outcomes while keeping the public blind to the mechanisms at work. The illusion of innovation played a crucial role. Financial products were marketed as breakthroughs that democratized access to wealth, promising stabilization, diversification, or unprecedented return opportunities. Yet behind the scenes, these instruments often concentrated risk in precisely the places most vulnerable to collapse. The growth of mortgage-backed securities, credit default swaps, and leveraged debt. Obligations created an ecosystem where profits soared as long as the underlying assets remained stable, but the moment cracks formed, the entire structure could implode. What appeared to be a system built on diversification was, in reality, a tightly interconnected network of liabilities, waiting for the right pressure point to trigger a chain reaction. When that moment arrived, as history repeatedly shows, the institutions that designed these instruments had already positioned themselves on the profitable side of the impending collapse. Governments and central banks became deeply intertwined with these mechanisms, not as neutral regulators, but as active participants. Their policies often incentivized excessive leverage, speculative expansion, and artificially low interest rates that encouraged risk-taking on an enormous scale. When instability inevitably surfaced, the solution was almost always the same: rescue the institutions deemed too essential to fail, inject liquidity into the system, and shift the fallout onto the broader economy. This response reinforced a dangerous reality. Major financial actors operated with implicit guarantees that protected them from the consequences of their own strategies. Knowing they would be rescued removed the natural restraints that normally prevent reckless behavior, allowing manipulation to flourish under the guise of systemic importance. Meanwhile, ordinary citizens bore the weight of these decisions. Pensions were eroded, jobs vanished, currencies weakened, and economies contracted while the architects of the turmoil emerged relatively unscathed. The public was told the crisis was unforeseeable, a perfect storm of unrelated events, or the result of consumer irresponsibility. But the deeper you study these episodes, the clearer it becomes that instability was not merely predictable. It was baked into the system as a necessary ingredient for profit. The volatility that devastated households around the world created fertile ground for insiders to acquire distressed assets, consolidate influence, and prepare the foundation for the next cycle of engineered growth and collapse. And with each crisis, the sophistication of these strategies expanded further. Technology increased the speed at which markets could be manipulated, global networks tightened the links between economies, and new products created fresh opportunities to exploit uncertainty. The financial world entered a phase where manipulation became not just a feature of extreme events, but a constant undercurrent shaping everything from interest rates to market sentiment, setting the stage for even more subtle forms of influence that operate beneath the threshold of public awareness. As the global system became increasingly interconnected, the most powerful financial institutions learned to operate not just within markets, but above them, shaping the very environment in which economic decisions were made. Influence no longer depended solely on capital. It depended on access, strategy, and the ability to anticipate how governments, corporations, and investors would react to carefully crafted signals. What emerged was a tier of financial actors who could quietly guide policy, sway public opinion, and affect international relations without ever appearing in the spotlight. Their leverage came from the subtle ways they interacted with central banks, regulatory institutions, think tanks, and political networks, forming an ecosystem in which financial power and political power became nearly indistinguishable. These institutions used their position to steer decision-making long before policies were publicly debated. Recommendations disguised as expert guidance, models presented as objective analysis, and forecasts delivered with authoritative precision shaped how leaders understood economic threats and opportunities. Yet behind these polished presentations were motives aligned not with public stability, but with financial advantage. Market-moving narratives could be introduced through academic papers, media briefings, or private consultations, all designed to create conditions favorable to those who already held the highest degree of market exposure. When a central bank hinted at tightening or easing, insiders had already positioned themselves to exploit the shift, turning policy into a predictable engine for profit. International organizations became part of this framework as well. Entities tasked with monitoring global risk or advising developing nations often relied on data and projections influenced by the same financial networks that benefited from the outcomes. A downgrade, a warning, a revised forecast, or a projected deficit could send shockwaves through economies, altering currency flows and investment trends overnight. These moves were framed as impartial assessments, yet they frequently aligned with the strategic interests of those who understood how to turn expectation into opportunity. The more interconnected the world became, the easier it was for a small circle of institutions to use these tools to coordinate their advantage across multiple regions simultaneously. Perhaps the most subtle yet powerful form of influence came from shaping market psychology itself. Fear and optimism, caution and euphoria, uncertainty and confidence were not just emotional reactions, they were strategic levers. By influencing sentiment through research reports, media narratives, or targeted speculation, financial giants learned how to amplify market movements in their favor. A well-timed warning could trigger sell-offs that opened the door for accumulation. A wave of optimism could push valuations high enough to justify large-scale profit-taking. Public perception became a battlefield where narratives were crafted with the same precision once reserved for financial instruments. All of this operated in a space just outside the awareness of ordinary investors, creating changes that felt spontaneous even though they were anything but. If you have ever sensed that certain economic shifts seem too synchronized or too conveniently timed to be accidents, share your perspective in the comments. Your interpretation might reveal patterns others have noticed but never fully connected. As these networks of influence expanded, the tactics used to sustain fraudulent fortunes grew even more sophisticated, relying on layers of secrecy and speed that made the modern landscape nearly impossible for the average person to decipher. Behind the scenes, financial elites developed strategies designed to operate beneath regulatory thresholds, taking advantage of loopholes, fragmented jurisdictions, and complex interbank arrangements that masked their true intentions. In this environment, manipulation evolved from visible market movements to subtle shifts in liquidity, pricing algorithms, and cross-border capital flows that allowed insiders to generate profit while leaving almost no trace of direct involvement. The opacity of these operations became their greatest shield, enabling actions that would have been considered blatant fraud in earlier eras to appear as routine fluctuations of global finance. High-frequency trading played a critical role in this transformation. By exploiting microsecond advantages and analyzing order patterns faster than any human could react, institutions equipped with advanced computing infrastructure could steer market direction without ever announcing their presence. They could trigger momentum, distort price discovery, and capitalize on arbitrage opportunities that existed only for brief moments. What seemed like natural volatility to the public often reflected calculated moves orchestrated by systems designed to stay one step ahead of everyone else. These algorithms acted not just as tools of profit, but as instruments of influence, creating market conditions that aligned seamlessly with broader strategies, unfolding across different asset classes. Another powerful method emerged through the structuring of offshore networks. Complex webs of shell companies, trusts, and layered financial vehicles created channels through which massive sums could move without detection. These networks provided anonymity, protected assets from scrutiny, and allowed manipulation to occur across borders where regulatory oversight was weak or easily influenced. By dispersing ownership and obscuring accountability, financial barons built fortresses of wealth immune to legal challenges and public exposure. These hidden structures played a central role in enabling unprecedented control over global markets, creating a world where capital could shift instantaneously while responsibility remained permanently out of reach. Simultaneously, the expansion of shadow banking systems introduced new spaces where enormous financial activities occurred beyond traditional monitoring frameworks. These environments facilitated enormous leverage, unrestricted lending, and speculative investment strategies that magnified both risk and profit. Because these operations occurred outside official balance sheets, they contributed to systemic fragility while appearing invisible to those attempting to evaluate financial stability. When disruptions emerged, they often did so suddenly and violently, catching regulators off guard but benefiting insiders who anticipated these fractures and positioned themselves to exploit them. All of these forces converged to shape a financial universe where manipulation became inseparable from the daily functioning of markets. Every subtle shift in currency valuation, every unexplained surge in commodity prices, every sudden increase in volatility carried the potential fingerprints of strategic positioning. And yet, because these mechanisms operated within the gray space between legality and deception, the public remained unaware of how profoundly their economic reality was shaped by decisions made far from their view, setting the stage for pressures that would soon spill into the lives of ordinary citizens in ways they could not foresee. As the hidden architecture of global finance continued operating in shadows, the real weight of these manipulative practices fell squarely on ordinary people who had no access to privileged information, no hedge against instability, and no way to protect themselves from cascades of decisions made far above their awareness. Each artificial boom pushed families to chase rising prices in housing, investments, and daily necessities, unaware that the very forces inflating these markets had already prepared for the inevitable reversal. When downturns arrived, they hit the public with full force. Savings were erased, businesses collapsed, currencies weakened, and employment evaporated, while insiders absorbed the shock effortlessly, positioned to accumulate assets at deeply discounted prices. This quiet transfer of wealth became one of the most defining features of modern financial manipulation. Yet it unfolded so gradually and so consistently that most people saw it as an unavoidable part of economic life. These cycles reshaped social structures as well. Entire generations were pushed into deeper financial dependency, taking on heavier debts in the form of mortgages, education loans, and credit systems designed to appear empowering but structured to extract long-term value. Interest rates that fluctuated according to global strategies rather than domestic needs ended up dictating the trajectory of millions of households. A single policy adjustment made in a capital thousands of miles away could determine whether a family kept their home or lost everything. The public narrative framed these outcomes as personal responsibility or unfortunate timing, but the underlying mechanics were far more deliberate, woven into international financial circuits built to prioritize capital flow over human stability. Small businesses and local economies were equally vulnerable. While large institutions could navigate volatility with sophisticated tools, smaller players were exposed to every sudden shift in liquidity, commodity prices, or currency valuations. A supply chain disruption engineered through speculative strategies could shut down entire industries. A credit tightening decided by distant financial committees could suffocate developing nations struggling to meet basic needs. These pressures deepened inequality across borders, allowing wealth to concentrate in the hands of those who not only understood the system, but actively shaped it. Even political landscapes were transformed by these dynamics. Governments burdened by debt or economic instability found themselves pressured into adopting policies that favored global investors rather than domestic populations. Austerity programs, privatization demands, and structural reforms were often presented as unavoidable solutions, yet they benefited the same networks that had contributed to the instability in the first place. Public frustration grew, but because these mechanisms operated in such complex and opaque ways, citizens struggled to identify the true source of their hardship, directing their anger at surface-level issues while the deeper systems remained untouched. Over time, a sense of inevitability took hold. Many people began to believe that financial crises were natural phenomena, like storms that appeared without warning. But when you examine the patterns closely, it becomes clear that these crises followed deliberate sequences engineered to redistribute wealth, influence policy, and reinforce long-standing hierarchies. And the more these mechanisms were accepted as normal, the easier it became for financial barons to extend their reach, preparing the ground for the next evolution of manipulation that would push the global economy into even more refined forms of hidden control. As these mechanisms of control expanded across borders and generations, the financial system evolved into a structure where manipulation was no longer an occasional abuse, but a continuous force shaping the rhythm of global markets. The same patterns that once appeared only during major crises began permeating everyday economic movements, influencing interest rates, capital flows, and asset valuations in ways subtle enough to escape public recognition, but powerful enough to determine the trajectory of entire nations. Modern financial elites no longer needed to destabilize markets with dramatic maneuvers. They only needed to guide expectations, adjust strategic liquidity, or exploit small cracks in the system to produce outcomes that aligned perfectly with their long-term objectives. The decades of accumulated influence, combined with unprecedented technological reach, allowed these actors to shape the global economy with a precision that earlier barons could have only imagined. For the public, this meant living in an environment where economic stability felt increasingly fragile. A minor policy announcement could ripple across continents, A shift in market sentiment could alter the cost of living within days. A single downgrade or recommendation from an international institution could trigger capital flight, even if the fundamentals of a country remained unchanged. This volatility was not merely the byproduct of complexity, it was the natural extension of a system optimized for those who thrived on uncertainty. And while some sectors benefited from short bursts of growth, most individuals found themselves adapting to rapid changes they neither caused nor understood, caught in a perpetual cycle of reaction. Meanwhile, financial institutions positioned themselves at the center of every movement, acting as both the architects and beneficiaries of global shifts. Their influence over political decision-making intensified, shaping regulatory frameworks, tax structures, and trade agreements that supported their strategies. By reinforcing policies that encouraged leverage, speculative investment, and cross-border capital expansion, they ensured that future opportunities for manipulation remained abundant. Each generation of market participants unknowingly stepped into a landscape sculpted long before they arrived, navigating systems calibrated to serve interests they would never see. Yet the most striking realization comes when you recognize how these patterns continue to repeat with remarkable consistency. The tools may evolve, the actors may change, and the technology may grow more advanced, but the underlying dynamics remain the same: concentrated influence and engineered volatility, and a constant cycle of wealth extraction disguised as natural economic evolution. Once these mechanisms become visible, it becomes easier to understand why financial crises emerge at the exact moments that benefit the most powerful players, and why the public is repeatedly left to absorb the aftermath. If you reach this point, it shows how deeply this topic resonates with you, and that alone makes this conversation meaningful. If the value of this journey made sense to you, consider subscribing so you can keep following insights that help decode the forces shaping the world around you. And if this final part connected with your experience, leave a comment saying something like this: "I am seeing the pattern." It helps the channel grow and keeps this dialogue alive. If you feel that this content deserves it, leave a like as well. And if you want to keep exploring, there's another video right here that expands on this story in a powerful way. Just click and continue the journey with me.